Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. Thank you for joining us. The objective of this show is to try to help you have a better retirement, especially financially. And so we do that by answering your questions. So feel free to send your questions in. You can send them in to asktom@talkmoneywithtom.com. Just like you see here on the screen, you can put them into the chat box. We'll try to answer your questions live. You can send in the questions at any point, and we have some questions today really relating to the market, which I think is a pertinent topic considering what's happening. You can obviously subscribe to our channel. We have over 1,000 videos now on the channel. You can go through and look at those. We believe that education is a big component of what really helps people have a better retirement. And so even if you're working with an advisor like us, it's probably still a good idea to learn as much as you can on your own about what's happening to your finances. So you can hit the little bell, get notified when we, get any new content on there, obviously. And then, of course, you can just ask us a specific question if you want by booking an appointment. You go to our website, which is a link here on the channel. Up in the corner is a book appointment button. Set up a time, 30 minutes to meet with Ethan and I on the phone or video, and we'll be able to hopefully answer your questions. So great show. Really looking forward to it. Feel free, send in your questions now. See if you can stump us with something. We're looking forward to anything that you might have interest in, specifically in asset management, retirement planning, and tax planning. Those are the three areas we tend to focus on the most. So looking forward to being able to try to help you today as far as that goes. Okay. Now, I do start off every show with a summary of kind of what I see happening in the stock market. Pretty appropriate today to be talking about the stock market because we're really having a big downturn day so far. And we've done some very significant things within our portfolio. As I've been talking about over the last several weeks, we've been getting sell signals on the different pieces inside of our model portfolios, and we've been moving those into T-bills and ultra short-term bonds. As of last week, we had 44% of our stock market exposure moved out into those areas, and roughly about 75% of our bond market exposure moved out into those T-bill and ultra short-term bond areas also. Again, these are things that just don't fall much. They don't gain much either. It's just a holding place until we see the market maybe settle down. We can come back in, start, hopefully buy low with those. But yesterday we did something even more significant. We moved the rest of our pieces in the stock market component out to T-bill and ultra short-term bonds, and we moved about a quarter of our exposure to the stock market into an inverse position, which just means that it actually makes money when the market goes down. And so today we're looking at a situation where the S&P 500 is down more than 2% as we speak right now, and so we're actually up on that inverse position about that same amount, a little over 2%. And I know this seems kind of strange, but we've got some, a scenario here where the market has been going down so much that we've decided to kind of hedge against that risk. We still have in our portfolios the legacy positions that our clients have asked us to keep. So they're still subjected to the ups and downs of what's happening in the market. And we also have some positions in our taxable accounts that we purchased for our clients, years ago that have large capital gains, and we're still keeping those. And one of the reasons to use this inverse is to try to offset some of the losses that could happen if the market comes down for those positions that we really need to keep. And so if you look at this chart, this is the year-to-date chart of the S&P 500. And you can see that blue line there, it's curving over. That's the 200-day moving average, so we're below that, so that's significant. It's also moving down. That red line is showing kind of the top trending line. You can see we touched it in March and early August, but didn't break through. So we're still in this downturn, and now that's why we're in these inverse positions because of that. But there's some things that have happened. A couple weeks ago, we were looking to try to hold that line. Mm-hmm. That was a pretty good support line, and we broke through, okay? Mm-hmm. And then we're trying to hold this line, right? This is, again, a pretty decent support level, not as big as the other, but still a support line. We broke that today, right? You can see that bar at the last day. That's today. Okay, so now what's the next level of support? And it's really the low for the year. On the S&P 500, that's 3636. Right at the beginning of the show, we were hitting 36.47.
Yep.
Okay, so when you retest a low, you don't always get to exactly that number. You can be close, a little high of it, a little long of it. In other words, you could go to 33.30 or 20 or what have you. And this is actually a fairly significant piece, and as far as that goes. But if we break through that with any type of power, the problem is the next level of support is so far away. And I have to go back to a 3-year chart here. That's the next level of significant support right there. And if you look back, you can see the big V drop that we had in 2020. But then there was 2 little drops that happened, 10% each, in September and October. The bottom of that is the next big support level. Unfortunately, that's about 13% from where we are here. So that's the cliff. I've been talking about standing on the edge of a cliff. And although we haven't fallen over the cliff, when you get closer to the edge, the risk gets higher. And so we've been building a parachute in case that risk it becomes actualized and we fall off of this cliff and we kind of have this cascading motion downward. So again, we've been packing that parachute with T-bill and ultra short-term bond ETFs. That's been working quite well over the last few weeks. It's worked out, that we've outperformed, at least in our models because of that. And then today, if you get a chance to take a look at your account today, you might be kind of surprised because the inverse position is up so much. And again, it depends on what other holdings you have that we didn't get rid of. But if you don't have any of those, our models are showing positive returns for the day, even though this is a pretty negative day. And so that's there. And so that's the issue that we're kind of dealing with here is just where these different support levels are. Because the next one, and I got to go back to a 5-year chart here, and you can see there's a lot of touch points here. But this is at about a 24% drop from where we are today. And so again, this is the cliff. One of the things that happens, you have to understand, when the market runs up very quickly without spending much time anywhere, like we did at the end of 2020 and most of 2021, you end up with very little support because the idea is that if I bought at this price and it went up, it comes back and I think, wow, I made money last time buying it there, I'm going to buy it again. But if it didn't spend much time at that price, you don't get much support. And support and resistance is just one of the issues that you'd want to look at with the overall market. It's a simple thing to talk about here, but we're looking at all kinds of, ATR trailing stops and, all kinds of different indicators that we're looking at to figure out what to do and what have you. Now, there is one other scenario here that I think is very important to consider, and that is that what is happening right now is, if you look at what's been going on, the market's come down a lot here very quickly, right? Since the beginning of August. We had one little bounce there, but basically straight down. And so this concept that I call stretching the rubber band, and I use that because the more you stretch a rubber band, the more resistance you get, right? And eventually it snaps back. There's a measure called RSI, and I use the Wilder's version of that. The RSI on the 14-day basis right now is really stretched out. As a matter of fact, and now we're down to this low, and I would be really surprised if there wasn't a lot of buying that happens at this low test, because this is what people have been waiting for. So you got that combination of overstretched to the downside and a point of purchase. I bet you we get a bounce. At least next week, that type of thing, maybe even closing today, we'll see what happens. But a bounce is probably coming. The question will be, is that bounce going to be big enough to get us back through really the 200-day moving average, which is that blue line there. And you'll notice the 200-day moving average is coming down to meet us. That's good. So is that red trend line. So the market won't have to go as far to get back through that. And traditionally, that's a sign of breaking out and starting a new trend. And we're starting a new upward trend. So we are at this kind of point of indecision. Even though the market is falling hard today, it's really falling because there's a big gap in support. And so the next support is that low point, and boom, we fell right to it just in one day. So, we'll see what happens, but it's really interesting.
Do you think if the bounce comes, it'll be a quick bounce, or it will be kind of like a slog upwards?
It would normally be a slog upwards because, you can have some strength in there, but you don't have conviction up front, so volume can be low. And unfortunately, all these support levels that we broke all the way down here are now resistance levels above us. So we got to slog through those. We're going to hit one and then sit there, and then we'd go to the next one and sit there, and go to the next one and sit there. Eventually, once you get true momentum, you get true buy-in and volume, you would blow through more of those resistance points a lot faster. But the main thing that would drive things will be short covering, and that's what's been going on. That big run up that we saw from the low June, mid-June to early August, there was a tremendous amount of short covering, and you can see that very simply by looking at, okay, the S&P 500 made 3%, and the most shortest stocks made 4.5%, or something along those lines. That kind of, at least to me, shows some of the short covering that's happening, because when you cover a short, you're buying back the stock, which of course makes it go up even more potentially. So, I would suspect that it would be something that would kind of slog. I think a real warning sign would be, though, if we fall through this low without really stopping, because we're on a waterfall fall right now. That's what I call that. Last 3 days, boom, boom, boom. If we continue that waterfall through this low next week, we're going to go down to that negative 13% from here type of thing, next level support. In my opinion, maybe not immediately. There'll be some bounces in there, but what they call capitulation, right, is what everybody's been talking about. Oh, we need capitulation for this thing to end. Could be what we're experiencing here as far as that goes. Might be some great chances to buy in there, as far as that goes. But right now, I'm not that aggressive that I want to go buying in here at this, point of resistance, just at this low. It didn't spend much time there. It's more of a psychological resistant point. There are people that are going to buy here, but we really need institutions to move in. The only people left in right now are individual investors. I just saw an article. The institutions have moved out. Individual investors are still there. Once they panic, that's when you get that capitulation. And then once those institutions come back, that's when we'll really get our turnaround. So, yeah, it's very, very interesting to see what's happening right now. But just so my clients know, we have taken defensive measures to try to protect against this. And, we'll continue to monitor that. It is quite easy, to sometimes get out and get into these inverse things. It's a whole nother ball game. So if you're ahead 3% or 5% or 10% where you would have been if you'd stayed in, it doesn't really matter unless you can get back in at some lower point. If you get back in at a higher point, then you might as well just stayed in, right? And so that will be the trick. And we have a whole bunch of little techniques that we'll be using to kind of get back into this a little bit at a time as far as that goes. But we got to see this waterfall, kind of slow down before we're really going to do that as far as that goes. So anyway, that's the key message for today about the market. It is what it is right now. We're kind of unwinding some of the excesses that were pushed in there from the pandemic relief that came through worldwide. This is going on across all these markets, and so it's just something to be patient with. We have established, at least in our accounts, some good protection. We're still working through all those different pieces, but we'll continue to do so. All right, Ethan, what's our first question?
So, what are some possible paths for the market over the next couple months with just the kind of the macro, factors?
Possible paths. Okay, so when we look at, especially the macro factors, kind of interesting because the leading economic indicator, right, is down. That's a pretty heavy signal that we're looking for a recession. Has been quite successful in predicting when we're going to have some stock market trouble. Also, we have an inverted yield curve, pretty steeply inverted on the 2 and the 10-year. We're working towards an inverted yield curve on the 3-month and the 10-year, I think, also. And so those are big areas that we're looking at. However, we always have to keep in mind that the market is operating in a forward-looking mechanism. So, they're looking 6 to 18 months from now, what's going to happen? And so one of the reasons the market's falling right now is the Fed has just upped their projections for how much they're going to raise rates. And now the market's kind of readjusting for that. And there's some expectations that maybe, we have a hard landing. So obviously one path is that we break through this low that we already established in June and kind of cascade down to the next level of support, which is about 2,800 on the S&P, which is about a 13% drop from where we are. Another path, of course, is that we hit this low and the market is so stretched out because we've had so much run down. The buying comes in and it really turns things around. And we could have this jump backwards. And then that will be something we want to watch to see, is that strong enough to get the market back through that 200-day moving average, right? Because that's the real goal in terms of reversing this downturn and turning it into a primary downturn. Primary trend right now is down. We want that to be up, right?
Yep.
And so this is part of the cycle, though. If you look back 5 or 10 years, and I've been trying to show this with my clients, it's like, look, if you look at 1 year, it can be terrible, it can be great, but look at the whole cycle. You get that big run up, and then you get that downturn, and if everything's working right, the downturn doesn't retrace everything, and then we get a new low, and we get another run up, and that's a normal process in the market. It's kind of how it works. And so anyway, that's the object there. Those are the two main paths. We break through this low, cascade down, hold this low. Short selling and what have you comes in, creates enough momentum that institutions finally get back in, and we reverse the trend. We're right there. We're right on the edge of this final kind of cliff, in my opinion. So I think we'll know a lot within the next, couple weeks. I suspect we bounce next week. Be my guess. If we don't, we'll probably fall quickly. But if we do bounce, it's going to happen next week.
So when we see these like drops, why is the downside always so much faster than the upside?
Yeah, you read basically, human psychology. So the stock market is a representation of human emotion. All right. We like to put rationalizations in there. We like to think about the PE ratios and, we study this stuff as if it's rational, but it's not in the end, especially in the extremes. And so the two main emotions, in my opinion, are greed and fear. And so on the upside, you'll generally see the market going up slower, and they'll see, like you just said, more like a cliff on the downside and then kind of the slow upsides. And so fear is a stronger emotion than greed, right? And so that's what happens. Once fear kicks in, then you see this motion to the downside that really can get quite strong. And that's what the market's looking for right now. At least kind of the professional investors are looking for this capitulation, this final fear, where all of these individual investors are still in there, freak out, sell everything, and just to protect what they've got. And that's when the pros will be back in there. So trying to buy that low point at some point in time. So that's what it is. It's a greed versus fear battle that goes on constantly.
So this is a question that comes up with a lot of client meeting. What is gift splitting?
Gift splitting. All right. So with gift splitting, we've got a situation where you can gift money, right, to really anybody.
Yep.
Up to $16,000. Correct. And so if I want to gift my son $16,000, I can. If my wife wants to give my son $16,000, she can. Excuse me.
Yeah, and so gift splitting is the idea where, as a couple, you can split that gift. So if, as a couple, we gave $32,000, it would be considered $16,000 from each partner. And so the idea is, because of the annual exclusion of being $16,000, the idea of gift splitting is that as a couple, we can gift more money. And so kind of in this illustration is, let's say Daniel and Lorraine gift to Drew, they can give $32,000. But when you gift to another couple, so you gift to their partner too, you can gift another $32,000. So when a couple gives to another couple, they can go up to $64,000. And so this is kind of if someone sets up a strategy using these kind of gift splitting, they can lower, they can maximize their exclusion, and so they don't affect their lifetime gifting.
Yeah, so let's say that this is a husband and wife trying to gift to their son and daughter-in-law, right? And so they want to buy a house.
Yep.
And husband and wife want to help them buy a house. And so what they might do is gift $64,000, right, for the down payment or whatever it is that they're going to need in that house purchase. And when they do that, there's no issue. We all have a little over $12 million right now that we can pass along to our beneficiaries. And if we give more than that 16,000, or in this case 64,000 from couple to couple, it comes off of that exclusion, which for a lot of people, we don't have that much money, so it doesn't matter. But you do have to be careful because the exclusion is going to shrink possibly in 2025. There's, it does sunset, and, you still want to, in my opinion, protect that exclusion as much as possible. You never know what might happen. You might have a windfall and have all of a sudden an estate that's worth more because the estate tax, you were telling me the other day, I think it starts off at 40%.
Yeah,
right?
essentially once you go past that exclusion, every dollar after that, you're paying 40 cents on it to the government.
Yeah, and so if you gift this the proper way, like this, with the 64,000 couple to couple, you're not affecting that gift exclusion at all. You're not, reducing your ability to pass money without that estate tax. So that's what gift splitting is. It's actually really common. We've dealt with this situation quite often, and so it is something that can be used.
And one caveat is, if say the couple needs $80,000 for their down payment, and you give them $80,000, that extra $16,000, 8,000 of each of it goes to your kind of exception. So each partner splits that over, essentially.
Yeah, exactly. I mean, best idea would be to wait till next year to give the rest. So sometimes you do this gift splitting in December. You give 64 now, you can give 64 in January,
Yep.
and so that's kind of interesting. Or you lend the rest instead of gifting it. There's some different things that you might be able to do. You have to check with your accountants and what have you to see how that works. But because sometimes
It can get pretty complex.
Yeah, buying a house around here is going to probably cost more than 64,000 for a down payment. So that can happen too. So anyway, that's what gift splitting is.
So now that you're out of the market, how do you plan, or when do you decide to re-enter the market? What are you looking for?
All right, so that's the golden question, right? I mean, it's not that easy to figure out when to get out of the market. It's not that easy to figure out when to go inverse instead of just moving into T-bills. And so we've done that already, and so far it looks good. But then the second step, of course, you got to get back in. Like I said before, if you've avoided 5 or 10% worth of loss, that's awesome, right? You did a perfect job of getting out. But if you're not careful, all of a sudden you'll have a situation where you're getting back in at an even higher point, and you're better off just staying in and going through the 5-10% loss and then coming back. And so what we watch for, we have a whole bunch of different buy triggers that we watch for. We use what's called an ATR trailing stop, which is a really cool little indicator that kind of takes into account the volatility of each holding. So when that signals buy, that we can maybe do it bit by bit, right? Mm-hmm. I use this stretch concept when the market is really stretched out. Normally, I use a 14-day period on my RSI with the Wilder, smoothing, and I want to see it below 30. In these situations, if you look back at like 2000, 2008, a 26-period RSI would have been better, period. So if I see 26 RSI go below 30, I'm going to nibble at that and put some money back in. It would have been a really, really good move. If you look back to 2000, a medium move for part of it, looking back to 2008, because it did fall beyond that standpoint too. And so I think it's a step-by-step approach. I'm looking for some moving average crossovers to happen that I want to see, and there's so these different confirmation points on when you're getting back in. Love to see the market get above 200-day moving average before I got fully reinvested, just because we've had 2 false moves that have collapsed at the 200-day moving average. So you get fully back in, and then boom, it comes down. So I think it's sort of a concept of, just like anything else, where you're going to want to take, okay, we're going to move 10% based on this indicator and another 25% based on this indicator, and we're going to basically have this process to come back in. And so we have tested this out extensively. We've tested it out against the 2000, 2008 downturns, which are the most like this one at this point in time, what we call this rolling bear market. And so, we've got some good ideas for when we might do what we've got to do. But this is such a unique environment. None of the data that we look at has the combination of a pandemic that causes China to shut down, a war in Ukraine that causes higher inflation, and a high inflation anyway. Even before the war, we were getting some inflation, and we got global inflation. So we got raising interest rates. There's not a scenario in modern data that's like this. So there'll be some feel about what's happening. You can kind of see it. I mean, if you really look, you can see, the volume. I love to see volume coming in on those upticks, and you can kind of see that buying happening. What's called on-balance volume is something we follow quite closely too. So, these are things that'll help us. We're not going to get the bottom. I'm not concerned about that. I just want to be able to kind of dollar cost average back in. And we could be out of this inverse quickly if the market just turns around and takes off, right? So, it's just one of those things. Luckily, we don't have, a cost on a transaction basis to really get in and out. There's some, bid-ask spreads and things that we have to deal with on some of these, but we don't have a commission anymore, which is good. So anyway, that's what we're looking for in terms of re-entry points.
So what is fundamental and technical analysis? Because you've been talking a lot about technical analysis, but what is fundamental too?
The fundamental analysis, I guess this is my opinion, in its strictest sense, is really looking at the fundamentals of the company. What type of revenues do they have? How have they been accelerating or decelerating? How does that, per share? What's their sales per share? I love that measure. What is their cash flow per share? What is their earnings per share? And so there's a book value per share. There's all of these different ratios that you look at even on a cursory basis to see. You can look at the whole market and say, okay, the PE ratio is at 15 or 16, the average is 18, so we're a little bit cheaper now, that kind of thing. And I think the other part for me of fundamental analysis has to do with the economic analysis that we look at. So the leading economic indicators, there's a basket of 10 indicators in there. When that curves over more than 1% from its high, we've had some pretty good sized stock downturns that have happened after that in 2000, 2008. That has happened already. We look at, I would consider to a certain degree, the inversion of the treasury debt. So 2 years paying more than the 10-year, 3 months paying more than the 10-year. Some people might call that technical, but I look at that sort of as the fundamental side of trying to look at what's going on. So there's a whole host of economic pieces that we look at as far as that goes.
And some of the softer side of fundamental analysis, if you're looking at a company specifically, like you could be looking at their product line,
Yep.
Let's say they've made a shift, they're adding a new product line that you think could be explosive. That's a fundamental analysis.
Yep.
Or you see they bring in someone that you think is a very well-respected person in the world, that industry, and they know how to run a company.
Yep.
And so you think this company can make a turnaround based on new management or something like that.
Yeah, exactly. Yeah, it's we don't do a lot of individual stock pieces. We do mostly indexes. When we do our targeted pieces, we've used a couple of individual stocks over time, but even those we're using indexes, just more narrower indexes as far as that goes. Technical analysis does lend itself well to a basket of stocks, and we can look at the fundamental analysis of that. But here's one of the funny things I was just thinking about the other day. I read an article saying that, well, Apple still expensive. It's 23 times earnings. I'm thinking, well, but it's been 40 and 50 before. And so people were willing to pay that. And so some people get really locked up on PE ratios, and they do think it's somewhat important, but there's a greed factor that will override that and drive that stock to 40 times earnings. And you could ride that. And it's a fear factor that could drive that stock down to 15 times earnings. And so, generally speaking, when you do see something that is quite cheap, I mean, we like Target. It got down to like 13 PE. That seemed pretty cheap. Moderna was like at 4 PE. That seems pretty cheap. And so it does factor in. You think, okay, maybe I don't have as much room to fall when I'm already that low on the PE ratio. So, there are some pieces that you look at as far as that goes too that I think are important. And you really can't, there, you keep looking at things, and you can't look at too many things. I mean, honestly, you can get a little bit overwhelmed, but the longer I've been in this business, the more things I end up looking at, and your repertoire has to be very, very broad. And if you're ignoring fundamental analysis and only technical analysis, I like the combination.
Yeah, and technical analysis is basically you look at the chart and you look at the price pattern, kind of the patterns you see in the chart, and it's very much you don't look at what the company does, but what is the chart saying and telling you.
Yeah, yep, exactly.
So, is it a good time to take a Roth conversion instead of waiting to the end of the year because the market is so down?
Yeah, so this is a question we're getting from our clients. Of course, you got to figure out what down was, because it was we looked down in April, and now we're lower than that. So, having said that, I look at it from, hey, we were higher. I look at the opposite direction. So the high was January 3rd or 4th, I think, of the year, right, for the S&P 500, and we're lower than that. And right now we're probably lower, maybe today about 24% lower on the S&P 500. So the idea behind converting when it is lower than the high is that you have to imagine at some point in time we're getting back to that high.
Mm-hmm.
Could be a few months, could be a few years, depends, right? In the recovery of getting back to that new high, if the S&P 500 does recover, we get to have that growth be tax-free if we converted it at a lower point. And we can try to guess where that lowest point is for the year, but it's not a bad deal. If I'm taking, say, $50,000 out of my IRA and moving it into my Roth and kind of buying, things at this lower point, as the market recovers, I'm, going to, benefit from that on a tax-free basis, instead of having that $50,000 sit in my IRA, growing tax deferred, which just kind of adds to my tax complications down the road, right? Mm-hmm. So, yeah, I think actually for anybody that's thinking about doing a conversion of Roth, the low point is really a lower point, like we're at now, is a really good idea. You do, if you are over 70 and a half, you do have to take your required minimum distribution.
72.
72. Change that. You do have to take your required minimum distribution before you can do your Roth conversion.
Mm-hmm.
So you kind of have the opposite problem there.
Yep.
Because now I'm taking my required minimum distribution at a relatively low point. Ideally, the best point this year would have been to take it, January 3rd, right at the top. But I still think it works out. You still take your RMD. Yes, you take a little loss on that. But the gains that you can make on tax-free growth for that conversion, I think probably outweigh that. Obviously, you got to look at the dollar amounts to figure that out exactly. But for most of the cases we've looked at, I still think it's worthwhile to do that Roth conversion if you're so inclined at this point in time. Yeah, I wouldn't have any trouble recommending that.
Mm-hmm. So, as the market gets worse, people start hearing more and more about scams because things fall apart. What are some things I can do to protect my investments from being scammed or, falling into any of these traps?
I think one of the things to understand about a scam is, and trying to avoid them, is to understand at least how some of them work, and how some of the major ones work. One of the things that I have seen that's common amongst a lot of scams is they're in areas that aren't regulated. You don't see a lot of scams coming out of the stock market as much as you do, say, at a cryptocurrency right now. So it's not regulated. People are making up, a coin or what have you, and selling that coin, and then turns out there's nothing. The money disappears, and so it's a lot easier in these unregulated environments to do that. And some of these other ones are hedge funds over the years.
Mm-hmm.
That again, they're unregulated also, and so not all hedge funds are bad or anything like that, but I'd be real cautious about it and really try to figure out what's happening there. So one thing that we have seen inside the regulated business is these little Ponzi schemes. So, and I've seen this, every firm out there has had some advisor that's done something like this, where they will gather money in the name of that firm. Let's just say it's Charles Schwab, for example, and supposedly they're putting the money in Charles Schwab, but they're actually not. They're depositing it themselves. They're promising some fantastic rate of return, 10%, 12%. That's another common thing to watch out for. But what they're doing is they're making phony statements. Mm-hmm. And so now you're getting this phony Schwab statement. And so one of the things you want to do in any of those scenarios is to make sure you have a direct portal connection to Schwab yourself, because it's not that difficult to make a phony statement, but it's impossible for them to make a phony website. So you go to Google, you type in Schwab portal, you go there, you try to sign in and set it up so you can see your account. And I think that's a really good, if you can't see your account or can't do that, maybe you call Schwab, ask them, because that would discover very quickly that this isn't happening, right? So, we had a scam here called Century Medallion. That's a little bit harder to detect, and that was a real estate agent who was selling second deeds of trust here, kind of a big Rotary member and what have you. Turned out to be a $100 million scam. I had another client who was actually a real estate agent himself who got ripped off for $380,000. He did some due diligence. He drove by the property that the second mortgage was supposed to be on. It looked good, but he never knocked on the door to find out if they were actually taking out a second. They weren't. So the guy was making up phony documents, but again, the one thing that was consistent there, I think that was a 12% return. So, they take your money, they get my $380,000, they give me back 12% return. They spend a bunch of it on their own lifestyle, and then it always requires new money coming in to make it work. Mm-hmm. And one of the things you're going to hear more and more about scams right now as the market falls, because that's when all of the scams kind of fall apart because they can't gather as much new money. People are being more cautious, holding money, need money, spending money, whatever it might be. Bernie Madoff, it's no coincidence that giant Ponzi scheme collapsed in 2008 when the market was falling apart. So watch out for high rates of return. Try to find some way to double check outside of the person or business that you're dealing with to see. So for us, we're holding our assets at TD Ameritrade. I always tell my clients, get the TD Ameritrade portal set up. There, you go there yourself, you can verify everything.
Yep. And if someone's guaranteeing rates, unless it's like a physical contract with an annuity firm, and you're probably going to get below market rates if you're getting a guarantee on it. And so if something's too good to be true, it probably is. And that's where these people, they prey on people's greed. Everyone wants that 12% return year over year, but it's not easy to achieve.
Yeah, it was one of the stable coins, which is part of the cryptocurrency universe, that was supposedly paying 9% with, no risk. And it did so for quite a while, which is part of the problem. I remember reading this article about this guy. He put in a little and he's getting 9. He put in more, he's getting 9. He's putting more. He put in, over $100,000, giant portion of his net worth. And he started telling his friends and his relatives. And the article was about how sad he felt because the whole thing collapsed in the end, because it really... You can't pay 9% when everybody else is paying 1 in a money market. It is a key thing to watch for. Yeah, watch for returns that seem too high. All right.
So you talked about market capitulation. Could you explain what that is?
So market capitulation is the final drawdown. And if you read a lot of articles right now and over the last several months, one of the things that they kept talking about was that this bear market, this down market's not over because we haven't had that final capitulation motion. If you look at charts, it's what I call waterfall. So and if you look at the last 3 days where you have a waterfall, I don't know if it'll continue or not, but where it's just boom, 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 and it's coming down just really, really fast. And that's just people throwing in the towel, right? Capitulation. They're giving up. We're holding in there, and now it's just too much pain. Every single investor and every professional or individual investor has some kind of pain point, that I'm willing to let it drop to here, and somebody else maybe is only letting it drop to there, and somebody else is even lower, right? But as those pain points are reached, people start to panic and get out. And you see that in this chart, in this capitulation, and that final waterfall effect to that bottom. And that's what has been talked about amongst the professional investing community throughout the last several months, we haven't had capitulation in this particular downturn. We might be experiencing it right now. It might be the beginning of it. We'll see. We'll see how this last barrier of this low that was set in June, see how that holds up. But that's what it is. And so it can be kind of a painful experience to go through. It's one of the reasons why, we have pulled out and are just waiting to see what happens here. But
yeah. Can you ever tell that you're in this kind of capitulation? Because it seems like, even like the pandemic drop, you couldn't tell when the bottom was going to be the actual bottom.
Well, figuring out the bottom and telling you're in a capitulation downturn are two different things. So can you tell if you're in a capitulation downturn? Yes, because it looks like a waterfall. You look at any of the oscillators like the RSI, and usually it gets to 30 and then turns around, all of a sudden it's down to 20. I mean, it's just really stretching the rubber band like really hard. That's what's happening at capitulation. Can you tell when you're at the bottom? For us, we've done some historical studies, and a 26 period moving, Wilder's smoothing RSI getting below 30 has been a sign of some bottoming, historically. Was the bottom in 2018, bottom in 2020. Wasn't exactly the bottom in 2008, but still would have been an okay buy point. And was a great buy point in 2000 itself. In those downturns, those are our four big downturns. They're all different, and so there are some pieces that you would look at like that where you might nibble. But there's a saying of be aware of trying to catch a falling knife, right? And that's kind of what you're doing there when you're buying that waterfall. You're just trying to catch a falling knife. Might get lucky and catch the handle, but so that's what capitulation is. Telling where the bottom is can be difficult, right? Because you get these bounces, what they call bear market bounce, where and we've had two, right? We had March, big run up, huge, really fantastic, failed. And then we had this massive run up here in July, early August, that failed also. And so that's what we call these rolling bear markets. So it's very difficult to tell. But if you look at a chart and you can see capitulation. So you'll know when you're in it. Believe me, a true capitulation event is a waterfall. The chart is just dropping very, very rapidly. So, we'll see if we're going to experience that here or not, but that's what it is as far as that goes. Okay, that's our show for today. Really, thank you so much for coming. I really appreciate all the questions. Send in your questions. We'd love to answer them. We're constantly looking for content. We want to answer, the things that you want to hear. So, we kind of hunt around for different things sometimes, but send them in during the week. Give us a chance to take a look at them. Of course, you can subscribe to our channel. Up the level of your education. It'll help you with your retirement and make your retirement hopefully more successful. You can subscribe, hit the bell button. And then if you have personal questions, set up an appointment. Go to our website, hit the book appointment button, and we'd be happy to, 30 minutes, phone or video, real simple, see if we can answer your questions, on a personal basis. So I want to thank everybody so much for coming today. Really appreciate it. Looking forward to seeing you again next week.